You're about to see a piece of market analysis that most retail investors will completely misunderstand. Right now, Wall Street is talking about Santa Claus rallies, AI super booms, and a potential 8 to 12% move in the S&P 500 for 2026. But almost nobody is explaining what that actually means for your money. In this clip, you'll hear how professional traders use seasonality, the Santa Claus Rally, and indicators like MACD to time entries and exits, while Main Street is still panicking over every headline and Fed whisper. So, watch this with one question in mind. Am I riding this bull market with a plan, or just hoping it continues?
For our phrase of the day, the Santa Claus Rally. This is literally a Hirsch family indicator. So let's break down what makes it an indicator. Well, it tracks the S&P 500 over the last 5 trading days of December and the first 2 trading days of January. How that 7th stretch performs can say a lot about the year ahead. And Jeff bundles it together with 2 other measures. He watches closely into what he calls his January indicator trifecta. So Jeff, break it all down for us. What is this January indicator trifecta?
Well, I mean, hats off to my late father, Yale Hirsch, creator of the almanac. In 72, in the 1973 Stock Traders Almanac, he invented the Santa Claus Rally and the January Barometer. Not to be confused with the January effect. January Barometer is as the S&P 500 goes in January, so goes the year. That's the full month of January. Santa Claus Rally, as you correctly described it, is the last 5 days of the year, first 2 of the year. It's an indicator. It's not some year-end trading strategy. And what happens during that period of time is usually a lot of people are off and the pros are in there picking up bargain stocks were sold for tax loss selling. And the market tends to be up a modest 1.5%. And when it's not, it's an indication that there are other forces that are at play, that things might be awry. So as Yale, the phrase that he invented or that he coined was, if Santa Claus should fail to call, bears may come to Broad and Wall. And for youngsters, Broad and Wall is the intersection in New York where the New York Stock Exchange.
Wall Street and Main Street. We love that right here on Stocks in Translation.
So it's important. The January trifecta. We take stand on Yale's shoulders. We put the first 5 days indicator, which is another indicator, in conjunction with the full month barometer and the Santa Claus Rally. Pretty impressive results there.
Yeah, so you can actually, by the end of January, we have a decent idea of how the year is going to end, and we actually get a couple indications in early January. So that's why I think we call it, you talk about it as an indicator. Let's back up, get big picture for a second. You said it's not a trading strategy. How should investors be thinking about seasonality? Because I've heard, and some of my own work shows like it has about a 1/3, it can drive about 1/3 of the market returns, but really not more than that.
It's a factor. It's one of the things we look at. I look at fundamentals, technicals, monetary policy, sentiment. So it gives you a little bit of an edge. And the thing that's important when seasonality is not working, kind of like the crux of the Santa Claus Rally, is that it's an indication other forces are there and the other forces are stronger.
Like Liberation Day, too.
Like Liberation Day, like AI booms, like, the bounce back, like the whole sell in May period was great this year. There's an indication that there's really strong underlying, fundamentals going on. And also when we cleared some of those resistance levels, technicals, overrode the seasonal weak period. So this is why we look at history as a guide. It's not gospel. I mean, nothing works 100% of the time. I mean, they say if you're right 60% of the time in the market, that's what you want to be. So we look for seasonal patterns that work or that have been consistent 60+% of the time. The little bullish and bearish days in the almanac is the days that the S&P has been up or down 60% or more of the time on that given trading day, using a little bit of our proprietary analysis.
For young investors who are looking to get in, maybe they're hearing for the Santa Claus Rally for the first time ever, and you say it's a slower week, that last week of trading, should they jump in or should they look around? Should they seek this out? Where do they even begin during this slower
You want to be in ahead of it. The fourth quarter is the strongest quarter. November, December, January, the 3 strongest months. So we like to get in October when we see a turn. Another one of Yale's, discoveries was October is the bargain month, the best time to buy stocks. Where we see bear markets bottom a lot. We had a nice bottom in 22.
Yeah, so hope everybody's long already.
You should be long already. And that's what we advise our subscribers or our members.
All right, I want to shift gears for a second because on today's Market Show and Tell, we're digging into the toolkit with MACD, or Moving Average Convergence Divergence. It is a mouthful, but it's really just a way of comparing short-term and longer-term moving averages to show when a trend is strengthening, fading, or about to turn. You can use it for free on the Yahoo Finance app or site, that's MACD, and usually you see MACD in 3 different parts or lines. The MACD line itself, which is the gap between those 2 moving averages, plus a smoothed signal line that lags it. And then there's usually a histogram of vertical lines that shows the distance between those other two lines. So you put it all together, it can look like a big jumbled mess unless you're used to looking at it. But tell us how you used it. You mentioned October, like a signal turning. Is the MACD involved in that?
Most definitely.
Yeah.
It really adds to the consistency of the seasonality. It improves the results tremendously. So the best 6 months, another Yale discovery, November through April. If we use MACD to get in early and get out early or later, and get out early or later, it helps with your entries and exits. It improves the results several fold. It turns what's a 7.4% gain to like an 8.9% gain, and if you compound it with compounded annual growth, it's much more impressive. So what we do is we look at more than one kind of MACD. Now, these are moving averages. They're exponential moving averages. Exponential moving averages is a moving average that puts more weight to the most recent data point.
So it moves faster.
It moves a little faster. What's a little more weighted towards the present as opposed to the past. And, everyone looks at 12-26-9, which is a 12-day minus a 26-day with a 9-day moving average of the difference.
3 different settings for MACD. Those are the ones you just laid out that are usually there, the defaults.
We use that for the sell side because it's a little bit longer, and we'll start looking in April, and because tops tend to be a process, they take time. But for our buy point, like what we had in October, we look at the 8-17-9. It's a shorter, faster MACD. Gets you in because bottoms tend to be a little bit more of an event, happen a little faster. And these are the original settings from the guy who invented MACD, Jerry Appel, another late great guy. And it's one of the classic, one of the most effective technical analysis tools out there, and it works really well in conjunction with our seasonal switching strategy, the best and worst 6 months of the year.
I think that if someone does want to get involved, maybe they want to jump in investing right now, they hear this and they're thinking, well, there's those certain things that happen, like the AI boom, like this Liberation Day, and that really spooked so many people on Main Street looking to get into Wall Street. So how do you sort of use this to sort of go around these mega days?
Yeah, I think like as an investor, you pull up the Yahoo Finance site, there's a lot of indicators. And we say, okay, look at the basic ones, the MACD one. But how do you begin?
You can begin with the almanac. It's in there. It's sort of made for beginners. It's on the desk of top managers. It's also great for people who are just starting out. We explain the MACD, how we use it with the seasonal strategy as well in there. Start with the almanac. Start reading. Read my intro. Read the outlook. We'll go to the back of the book and look at some of the explanations of how to profit from your own mistakes, how to write things down and keep track of things. It's built for you to take notes and write things down and keep track of what you're doing. Especially in this digital world, it's nice to have something analog you can carry with you and put pen to paper with. Yeah. So you got to do a little research. Read up on MACD.
Right.
I want to come back to the time of year that we're in right now, because this tends to be the time of year when small caps, outperform. So you got smaller caps, they tend to do a little bit better. And I remember like last week or 2 weeks ago, we had a 5-day stretch when small caps rallied, like Russell 2000 was hitting a record high. So tell us about the seasonality of that.
Sure.
One market versus the other.
Yeah, something called the January effect, which used to be the tendency of small caps to outperform large caps in January. We've seen that shift into the prior year. Most of it happens the last 2 weeks of December, but as you're pointing out, it does tend to pick up around the end of October and around Thanksgiving in November as well. And we're seeing that. So the pattern that we illustrate is we look at the middle of the year. It's the Russell 2000 versus the 1000, and we're seeing it start to track that, and that seasonal, bullishness of small caps starting to stir here. Looks like it's pretty good, but it kind of ends mid-January into February a little bit, so you want to be careful not to ride it too long.
Episode is brought to you by the number 12%. That's the upper end of Jeff's S&P 500 forecast for 2026. Now, the lower end is 8%. So all in all, not bad for year 4 of this bull market. And Jeff, I know you're looking at 2026 in the context of the 4-year presidential cycle. So walk us through this base case that you have.
Well, midterm years are notoriously the worst year of the 4-year cycle. We had the bear market in 2018. But we did have a reset earlier this year with the April tariff tumble, and a bunch of technicians, as we've spoken about, thinking that's a reset, ourselves included. So what might normally be a bearish year for the midterm year might be a little more bullish, especially considering the AI boom that we're talking about and the reset that we had. So while we do expect some weakness Q2, Q3, which is the weak spot of the 4-year cycle, Q2, Q3 of the midterm year, that sets up the bottom picker's paradise, another one of Yale's phrases, the sweet spot of the 4-year cycle, the 3-quarter combo, Q4 of the midterm year to Q2 of the pre-election year, potential for a 50% gain of the Dow, even more like 67% for NASDAQ from the midterm low to the pre-election year high. But thinking about all of the fiscal stimulus, the big beautiful bill, the deregulation, the easy Fed, and the reset sort of shifts our midterm outlook a little bit. It's been shifting as we're still putting together our final forecast for 2026, but it's shifting a little bit more bullish to that sort of 8 to 12%, with maybe dipping a little bit negative, or at least getting close to the zero line in the middle of the year around Q2, Q3.
All right, so maybe a little bit of trouble in the middle of the year, but coming out strong once again. I want to focus on what you just said, that reset. And of course, we're talking about in April of this year, we had that post-Liberation Day sell-off, and it was very short-lived. And before you blinked, we were back up at record highs.
Right.
And the nature of a bear market is that it is a reset. And while this technically wasn't a 20% decline in the S&P 500, so you didn't see any bear market headlines, it sure felt like one. And so talk to us about how these resets can set up kind of a brand new cycle, and maybe we're in the first year of a brand new bull market.
Arguably, we may very well be. We're in the middle or the early stages of the secular bull market, which is going to go on for a while, I expect. That reset, I mean, if you think about what the VIX did, over 50, I mean, you're talking about that fear spiking. We may need to reset like the world needs new models. The Fed needs new models. Maybe us market and analysts need new bear market models. I mean, if we use the Ned Davis research models, which is like 13% over 145 calendar days, or a reversal of 30 in the value line, whatever, or when people look at the 20%, which is arbitrary. But as you're saying, it did feel like a bear market. It was quick, but the fear was rampant. The selling was rampant. And once we came out of that and busted through all those resistance levels, perhaps, a little hindsight we'll need to see if it really was a bear market and if we're in a new bull market. But the market's behaving like it is, so, don't fight the tape.
And what did this sort of prove to you? Because you're saying don't fight the tape, but this really had Main Street really concerned. I mean, people were so fearful of their 401ks. Everyone's telling them not to look. So did this kind of just prove stay long?
I don't know if it proved stay long. It proved by the VIX at greater than 50, by the market when the VIX hits greater than 50. It proved don't sell at those bottoms, but there are times to not be long. It proved to not react, to not be emotional when the market's down like that. That's not when you sell. You want to be getting out more, calculated at upper levels, of the market. So when the market sells off like that, that's not the time to sell.
Yeah.
Stay long then, but not necessarily 100% of the time.
Right.
All right, let's break down what you just heard, because there's a lot hiding between the lines. First, when Jeff Hirsch talks about the Santa Claus Rally and the January trifecta indicators, he's basically saying this. Professional investors use time as an edge. They know that certain windows, like late December into early January, have historically tilted the odds in favor of being long. That doesn't guarantee anything, but it means if you're completely ignoring seasonality, you're playing with one eye closed. Second, the AI-driven boom and his 8 to 12% S&P 500 target for 2026 aren't just random guesses. They sit on top of a bigger idea. We may be in the early or middle stages of a secular bull market, powered by a real technological shift, not just hype. But notice how he still expects turbulence in the middle of the year. That's your reminder that even in bull markets, drawdowns are normal, not a sign to panic sell your portfolio. Third, the comparison of Volcker versus Powell and the phrase "don't fight the tape" is crucial. Translation: you can argue with the Fed all day, but price action wins. If the index keeps making higher highs and higher lows, the market is telling you something, whether you emotionally agree with it or not. And finally, the biggest lesson for regular investors: when fear spikes, VIX blowing out, headlines screaming crash, that's often when professionals are building positions, not dumping them. The people who survive and compound are the ones who stay systematic, not emotional. This is the Cryptagon. Stay sharp, stay informed.